From the following data represents the ratios of MS Bangalore traders for the year ended 31st March 2016. From the below mentioned particulars, uh, prepare the balance sheet of Bangalore traders as on 31st March 2016, assuming all sales that are made is on credit. Okay, so what has been told to us in the question is that they have asking us to construct the balance sheet of Bangalore traders. They have given us the values. They've told us that annual sales is 2 lakh, net sales to net worth is 4 times, current liabilities to net worth is 50%, total debt to net worth is 80%, current ratio is 2.2 times, sales to inventory ratio is 8 times, average collection period is 40 days, fixed assets to net worth is 70%. So using these details, we've been asked to go about with the construction of the balance sheet. Another important aspect that you have to remember in this question is that here, if you look at the actual values that have been given, we only have current ratio and average collection period. These two are the only proper ratios which have been asked to us in the question. So everything else, these are merely expressions. If they are not ratios by themselves, they are merely expressions of the values that have been represented. So let's go about trying to solve this particular question. Remember, as we had learned previously, our approach will remain the same. What we would be doing is we would be writing down all the pieces of information that has been given to us in the question, and using those pieces of information, we will try and process the data, and we will try and see if we can draw some meaningful conclusions. Okay, so that is what has been given here over here. Okay, so let's try and solve the question now, and let's start writing down the. So as we had discussed earlier, the approach in terms of solving these kind of questions should be the same. We have to make sure we list out all the pieces of information that have been given to us in the question. Let us make sure that we are leaving adequate spaces in between, and once we are leaving at those adequate spaces in between, we will be able to come back and solve later. Probably around 3 to 4 lines per between each piece of information should suffice, or that should be sufficient. Now, one important disclaimer that we have to remember at the back of our mind is what has been mentioned in the question. We have to assume that all the sales that is made during this time period of the preparation of the balance sheet, it has all been made on credit. So that's one important pointer that we have to remember in our minds. Okay, so that is something very important, because it will play a crucial role during the preparation of our question. So let's start off with, we know annual sales is 20 lakhs, sorry. So this is a straight piece of information that has been provided to us. There is nothing much that we will be able to do with this. We can just process this information. There is nothing much that we can do with this. Next, what has been told to us is that sales to net worth is 4 times. So what does this mean? Sales divided by net worth. Okay, so this is 4. Okay, so sales divided by net worth, so this is 4. Or in other words, sales is equal to 4 times your net worth. Okay, so sales is equal to 4 times your net worth, or net worth. Okay, net worth is equal to sales divided by 4. Okay, so net worth is equal to sales divided by 4. So that is what. Now we know the value of sales. So net worth is equal to 20 lakhs divided by 4, which means net worth is equal to 5 lakhs. Now remember, what is the significance of net worth, or what role does net worth have to play for us? Now net worth refers to nothing but your share capital. Okay, net worth is nothing but your share capital. When we talk about net worth of a company, we are talking about share capital of a company. So we've got one of the items to populate into the balance sheet, which is share capital, or which is net worth, and this we will be able to utilize over there. Now, next piece of information that has been given to us is that current liabilities into net worth. Okay, so this is 50%. Okay, this is 50%. Or current liability divided by net worth, this is 50%. Or current liability divided by net worth, this is equal to 0.5. What is 0.5? 50% is 50 divided by 100, which becomes 0.5. Or current liability is equal to 0.5 into net worth. Okay, 0.5 into net worth. Now we already know the value of net worth, so current liability is equal to 0.5 into net worth, which is 5 lakhs. Okay, 5 lakhs, or current liability is equal to 2,50,000. Okay, current liability is equal to 2,50,000. So current liability, how do we apply current liability? Current liability we would be using as a part of our balance sheet preparation. Okay, so that's where we will be using this. Okay, next thing is total debt to net worth. Okay, total debt to net worth, that is 80%. So let's solve this. So total debt divided by net worth. Okay, so this is 80%. Or total debt divided by net worth, this is 0.8. So how did we get 0.8? 0.8, 0.8 is nothing but 80 divided by 100. Okay, so 80 divided by 100, that is what is meant by okay. Now so which means total debt is equal to 0.8 into net worth. Okay, so 0.8 into net worth, or total debt is equal to net worth we know is 5 lakhs. So 0.8 into net worth is 5 lakhs, or total debt is equal to 4 lakhs. Okay. Now, what is the significance of total debt? Okay. What do you mean by total debt? Total debt means total liability. Okay. Total debt, what that means is total liability. Or what total liability, how do you get total liability? Total liability is sum total of long-term liability plus current liabilities. Okay, so the sum total of long-term liabilities plus current liability will give you total debt. So in this, we already know the value of current liability. We know the value of total debt. So let's rearrange this formula. When we rearrange this formula, what we get is long-term liabilities is equal to total debt minus current liability. So when we substitute, what happens is we will get total debt is 4 lakh minus current liability is 2,50,000. Okay, so which means long-term liability is equal to 1,50,000. So total debt is long-term liability is 1,50,000. Okay, now let's move on to the next ratio. The next ratio the next information that has been given to us is current ratio. Current ratio, we know the formula is current asset divided by current liability, or current asset divided by current liability is equal to 2.2, or current asset is equal to 2.2 into current liability, or current asset is equal to we already know the value of current liability. Okay, we already know the value of current liability. So current asset is equal to 5,50,000. Okay, so this becomes 5,50,000. 5,50,000. Okay, so So, okay, I'll just explain the step. 2.2 into, we know the value of current liability from here. So that is 2,50,000. So which current asset is equal to 5,50,000. Okay. So next piece of information that we have is sales divided by inventory. Sales divided by inventory, this is 8 times, or sales. So when we cross multiply, we would get that when we transfer the known and the unknown to each other sides, we would get inventory is equal to sales divided by 8. Okay. So, or we already know the value of sales. So inventory is equal to sales is 8 lakh, sales is 20 lakh. So 20 lakh divided by 8, or inventory is equal to 4 lakh. Sorry, it's not 4 lakh, it should be 2,50,000. Okay, so this is 2,50,000. So inventory is equal to 2,50,000. Okay, so we've got the value of inventory as well. So what is the other term for inventory? Inventory is nothing but stock. Okay, so inventory is nothing but stock. So we've got another item to fill into the balance sheet. Now, next information that has been given to us is that the formula for sales to inventory. So we know average collection period. Average collection period, it is given to us as to be 40 days. Now, what is meant by average collection period? Average collection period refers to the time frame with which you are able to collect back your money from credit sales. So if at all you're carrying any kind of credit sales, how quickly, this will give you a measure of how quickly is the money coming back to you. That is what is meant by average collection period. So we notice that the average collection period over here, it is we would notice that it is 40 days. So what does that mean? It means that whenever you carry out a credit sales, the money would be coming back to you in 40 days. Okay? So you would be able to collect the money back within 40 days. So that is what is meant by average collection period. So here the average collection period's formula. Okay. So now you could express it in different ways. If you express it in terms of days. Okay, so in this case, what has happened is the average collection period they have expressed in terms of days. So the formula is debtors divided by credit sales into 365. Okay. Now another way that the average collection period would be expressed is that it could be expressed in terms of months. Okay, it could be expressed in terms of months. So if it's expressed in terms of months, instead of 365, this will be 12. Okay, so this is the formula for average collection period. So please make a note. Average collection period, it is debtors into credit sales into 365. Now, had it been mentioned in terms of months, so this is what the formula is. Okay, so let's just quickly solve for this. So we know that debtors. Okay, so what we know is that debtors divided by credit sales into 365. Okay, into 365. This is 40 days. So this is 40 days. This will work out to be 40. So this will work out to be 40. So in this, we know the value of credit sales. We know the this thing is being. So we can rearrange this formula and we can calculate debtors. So let's calculate debtors. So when you rearrange the formula, you would get debtors to be 40 into credit sales. Okay, so credit sales is how much? Credit sales is 20 lakhs. Okay. So how do we know that is credit sales? Because what has been told to us in the question is that the entire sale is for is on this divided by 365. So when you solve for this, okay, when you solve for this, you would get the answer for debtors. Okay, you would get the answer for debtors. So debtors is 2 lakh. The debtor value is 2,19,178, and then it comes furthermore in decimals. So since the remaining is coming in decimals, I'm just rounding it off. So the answer is 2,19,178. Okay, so that is your value of debtors. Okay, so that is the value of debtors. Then next piece of information that we have is fixed assets. Fixed assets to net worth. So fixed assets divided by net worth. Okay, so net worth, we've been told that this is 70%, or fixed asset divided by net worth is equal to 0.7, or fixed asset is equal to net worth into 0.7. Okay, so let's multiply for this. We already know the value of net worth. Net worth is 5 lakh. 5 lakh into 0.7. So 5 lakh into 0.7, this works out to be 3,50,000. Okay, so fixed assets works out to be 3,50,000. So fixed asset is another item for your balance sheet entry. Okay, so we've got pretty much most of the information that has been given to us, except for annual sales. All the other pieces of information that has been provided to us in this question, we have acted upon. Okay, so all the other pieces of information that has been given to us in the question, we have acted upon those. Now, dear students, one final step that we will have to carry out right now is preparing the balance sheet. So now what the next step that we're going to be focusing on over here is pre-preparation of the balance sheet. And balance sheets, we've got the format ready, we've got liabilities, we've got the assets, and let's start off with this. So share capital. Okay, share capital is 5 lakh. Share capital is 5 lakh. So we've got that. Okay, now next piece of information, let's see which is the next piece of information that we can fit in. We have current liability, and something that we have noticed over here is that we don't have the breakup of the current liability. So I'm just going to enter this as it is, current liability. So that has been brought in. So this is current liability. What we have computed from here is 2,50,000. Okay, 2,50,000. So that has been taken into consideration. Okay, then next piece of information that we had calculated was share capital. Long-term liability. So long-term liability we can fit in. Now, what is the other term for long-term liability? The other term for long-term liability is that it is nothing but your loan. Okay, so long-term liabilities, and this is 1,50,000. Okay, so this is 1,50,000. Just do a small adjustment over here. So that improves the view. Okay. So there are no other items that we have in the question which fits onto the liability side. Now we can move on. Now let's see which are the other items that we can fit in. From here we've got fixed assets. So fixed asset will fall on the asset side. So fixed assets. So fixed assets we've got fixed assets, we know it is 3,50,000. Then what we have is we've got current asset. Okay, now I'm not taking current asset as it is. Instead of current asset, what I would be taking is I would be taking in the components of the current asset one by one, because I've already got some parts of the current asset. Okay, so I'm not going to take current asset as it is, because I've managed to get some of the components of the current asset. So what are the components that I have? I have stock. Okay, so stock is stock. We've calculated stock over here. So stock, we know, which is nothing but inventory, and inventory is 2,50,000. Okay, so this calculation, I'm just going to fit in here 2,50,000 that I've brought in. Then what we have is we have debtors. Okay, we have debtors. So debtors is 2,19,178. Okay, 2,19,178. So that also I have got. Okay, now we have a small condition over here. The condition is that we know that the total current asset. Okay, we know that the total current asset here is 5,50,000. Okay, we know that the total of the current asset is 5,50,000. What we also know is that in this particular firm, the total current asset comprises of stock plus debtor, and then plus we need one more item. Okay, and the sum total of these three should be 5,50,000. Okay, it should be 5,50,000. So I am going to be assuming missing current asset to be cash. Okay, it is not necessary that you have to take it as cash. You can take it to be anything. Okay, any current asset. So in my case, what I have done is I have assumed that the missing current asset to be cash, but it is not necessary. You can assume it to be any current asset. It could be bills pay, it could be bills receivable, it could be cash at bank, cash in hand, etc. It could be any. So I'm assuming this to be the missing current asset to be cash. Okay, so now we know that the total current asset is 5,50,000. This is sum total of 2,50,000 plus debtor and debtor. So debtor, we know this is 2,19,178 plus cash. So cash is equal to 5,50,000. Rearrange the formula. 5,50,000. Okay, it will be 5,50,000. 5,50,000 minus 2,50,000 minus 2,19,178. Okay, so when you do so, that is when you will get the value of cash. So that's when you get the value of cash. And when you solve for this, what you would be getting is that. Okay, so let's quickly work this out. 5,50,000 minus 2,50,000 minus 2,19,179. When we solve this, we would get the answer to be 80,881. So that is your cash. So we would substitute for cash over here, and this works out to be 80,821. And let's try and total up and see if both the sides are matching. Here it is 8 lakh. Okay, so this would be 9 lakh, and here let's total up this.
So it's 822.
Beg your pardon?
It's 80,822.
Okay, sure. 80,008. Even if you were to take it as 17. Okay, sorry. Okay, that's because I had typed here the value incorrect. Thank you for bringing that to my notice. So this would be 822 here, and then total. This is it matching? It is matching. Okay, so liability side is equal to the asset side. Okay, so liability side is equal to the asset side, and both of it has matched with each other. Okay, so in our case, our balance sheet preparation is perfect. Both the asset is matching with the liability, which means we have our balance sheet preparation is absolutely perfect. Okay, so what we have done over here is the missing item. We have assumed this to be cash, and we have calculated actually the balancing figure over here. Okay, so this with that we have completed this question. Even our balance sheet is also ready right now.